Right now, as we step into April 2026, something unusual is happening in the financial world, and almost nobody is fully paying attention. Silver is hovering in the $70 range, gold is holding strong at elevated levels, and to the average observer, it might look like the excitement is already behind us. The big move already happened, and now things are slowing down. But that assumption could be the biggest mistake an investor makes this year. Because beneath the surface, the behavior of silver is telling a completely different story. This isn't a market cooling off, this is a market resetting, preparing, building pressure for a move that could shock almost everyone watching from the sidelines. Another important element in this environment is the breakdown of long-term resistance levels that had previously capped silver for decades. Historically, silver struggled to sustain moves above certain psychological and technical thresholds. Each time it approached those levels in past cycles, selling pressure would emerge and push prices back down into familiar ranges. But recently, those multi-decade boundaries have been challenged and in many cases surpassed. When a market escapes a range that has held for 30, 40, or even 50 years, it often does not return to that same equilibrium. Instead, it begins to search for a new valuation zone, one that reflects updated market realities rather than historical constraints. At the same time, the broader macro environment adds another layer of complexity. Global liquidity has expanded significantly over the years, and the long-term trend in money supply has been upward across major economies. This expansion does not simply increase asset prices uniformly, it changes how value is perceived across different asset classes. As more currency exists in the system, tangible and scarce assets tend to attract attention as stores of value. Silver, unlike purely monetary assets, sits at the intersection of industrial demand and monetary perception, which makes its behavior especially sensitive to shifts in liquidity and economic confidence. In periods where financial systems show signs of stress, capital tends to reposition itself. Bonds, equities, and credit markets can experience instability when debt levels are high and interest rate environments become restrictive. In such scenarios, central authorities often respond with liquidity measures designed to stabilize the system. While these interventions aim to support financial assets, the resulting capital flow does not always remain confined to those markets. Over time, a portion of that liquidity tends to move toward assets that are perceived as scarce, durable, and less dependent on institutional stability. This is where metals like silver often begin to attract increased attention. And the reason this conversation is heating up again comes from a well-known momentum analyst, Michael Oliver, who has spent decades studying how markets behave before massive breakouts. He's not someone who throws random predictions for attention. His work focuses on structure, on momentum shifts that happen quietly before explosive moves. And according to his latest view, silver is not done, not even close. In fact, his projection is bold enough to sound unrealistic at first. He believes silver could climb into the $300 to $500 range during this cycle, not as a long-term dream, but as part of the current unfolding phase. Now, before dismissing that as hype, it's important to understand what kind of move he's actually describing. This isn't about a slow, steady climb like we see in typical markets. This is about what happens when a long-suppressed asset finally breaks free from decades of resistance. For nearly half a century, silver struggled to stay above a certain level. Every major rally eventually hit a ceiling and reversed, but that ceiling is no longer holding. And when a barrier like that breaks after decades, markets don't behave normally anymore. They don't move politely. They don't give everyone time to adjust. They reprice, fast, aggressively, and often violently. If you look at how silver has been behaving recently, the pattern becomes clearer. Sharp rallies followed by sudden drops, fear spikes, then equally fast recoveries. To inexperienced eyes, it looks unstable. But in reality, this kind of movement often appears in the early stages of powerful bull markets. Strong hands step in during weakness. Selling pressure gets absorbed quickly. And instead of collapsing, price snaps back with force. That's not weakness. That's demand hiding beneath volatility. Now, many people are trying to link these movements to headlines: geopolitics, conflicts, oil prices, global uncertainty. But history tells us something different. Precious metals don't consistently move because of war or news events. Sometimes they even fall during major global crises. So if it's not the headlines, what is driving this? The deeper answer lies in the monetary system itself. Over time, the amount of currency in circulation continues to expand. More money enters the system, but the real-world value behind it doesn't grow at the same pace. This imbalance slowly erodes purchasing power, and assets like gold and silver act as a reflection of that process. They don't just go up. They reveal what's happening to money. At the same time, cracks are beginning to appear in areas most people don't watch closely: debt markets, financial institutions, long-term credit systems. These are the foundations of the modern economy. And when stress builds there, the response has always been the same: more liquidity, more intervention, more money creation. And when that happens, capital doesn't always stay where policymakers expect it to go. It searches for safety, for scarcity, for assets that cannot be created out of thin air. That's where silver enters the picture, not just as a precious metal, but as both a monetary and industrial asset. It sits at the intersection of two powerful forces. On one side, it benefits from monetary demand during times of uncertainty. On the other, it is heavily used in modern technologies, especially in areas like solar energy and electrification, where demand continues to grow regardless of short-term economic cycles. And here's the key problem: supply isn't keeping up. Mining new silver is not something that can happen overnight. It takes years of development, investment, and infrastructure. Meanwhile, existing production is already being stretched. Recycling helps, but it's not enough to close the gap. So what you end up with is a rare combination: rising demand, limited supply, and a monetary backdrop that pushes more capital toward hard assets. That combination doesn't lead to small moves. It leads to revaluation. On the supply side, silver faces structural limitations that cannot be easily resolved in the short term. Mining output is constrained by geology, capital investment cycles, regulatory timelines, and operational challenges. Bringing new supply online is a slow process that can take years. Meanwhile, existing mines often experience declining ore grades over time, which further limits production growth. Recycling contributes to supply, but it is not sufficient to rapidly offset deficits when demand is rising across multiple sectors simultaneously. Demand itself is not static. Industrial usage of silver continues to grow, particularly in sectors tied to modern technology and energy transition. Applications such as solar panels, electronics, and advanced manufacturing rely on silver's unique properties. This creates a baseline level of demand that is less sensitive to short-term economic fluctuations. Even during periods of economic uncertainty, these structural uses persist, providing a consistent source of consumption that supports the market from the demand side. Now, does that mean silver will go straight from current levels to extreme prices? Not at all. In fact, if history is any guide, the path will be anything but smooth. There will be sharp corrections, sudden drops, moments where it feels like the entire move is collapsing. But that's how major trends behave. They test conviction, they shake out weak positions, they create doubt right before the next leg higher. And that's exactly why most people miss them. Because by the time the trend becomes obvious, it's already far advanced. What makes this moment different is not just the price level, it's the shift in behavior, the speed of recoveries, the strength of underlying demand, the inability of the market to stay down even after aggressive sell-offs. These are subtle signals, but they matter. They suggest that something structural may already be underway. So instead of asking whether silver looks expensive today, the better question might be, what happens if this is still early? What happens if the current levels are not the peak, but the base? Because if that turns out to be true, then the real move, the one that captures global attention, hasn't even started yet. And when it does, it likely won't give much warning.